So we're now recording, and so just to let everybody know if that's okay. So I'm going to crack on now. So crunch time, get the most from this tax year's allowances. So tax is one of the greatest detraction from every pound in your pocket and my pocket. In a low return environment, it's very challenging to keep your head above water, and particularly we're talking about inflation as well here. The onerous tax levies we face on income and capital, and even sometimes those that we want to leave behind. So we're talking about inheritance tax there. And it's clear that building tax efficiencies into your financial plan is important. And that's one thing that all of us will always work on in the first instance is how can we be most efficient in our investments in terms of tax mitigation. So today we're going to talk about tax planning and some of the key steps that you could take before the end of the tax year, which is obviously April 4th, 5th, which could result in some mitigation or reducing exposure to unnecessary tax using allowances and exemptions with tailored financial planning. So here we go. That's us. So Mann Chartered Financial Planners. I'm here. Richard is here as well. He'll be talking just a while, but also he'll pop on to interject. And he's going to do some of the more difficult, serious stuff in a bit. And on the screen there, you've got David. And we also have Tracy, who's joined the team recently. Alison is there. And I think Ed's maybe joining us on the webinar, who's a very bright young man who's going through our academy and will be joining us in a few months' time. So some of our clients, some of you clients will have met Ed already and also will be seeing him in the future. So Mann Chartered Financial Planners. So tax planning, taxing times. It's taxing times in many ways, actually, apart from tax. We've got lots of headlines going on. A little bit later, we'll probably do just a little bit of an informal update on the markets and what's happening, which Richard will cover off in a little bit of time. But as you know, we've got a few things going on. So tax planning is an important aspect of financial planning, but it's important to approach things on a personal level, because we're all exposed to tax in a different way. Some of us are non or even basic taxpayers, and some of us may be higher rate and additional rates, so up to 45% tax. Some people may be more exposed to capital gains tax on certain assets, and also then looking at inheritance tax at another time in our lives. So whatever the scenario, to avoid the temptation to look for the silver bullet solution, which has gotten some celebrities into trouble. You often, although Richard will talk about enterprise investment schemes and venture capital trusts and the things that we do work with, you heard of some of the footballers and who's the comedian, Richard? Who's
Jimmy Carr.
Say again?
Jimmy Carr.
Jimmy Carr. So you know, and he often cracks jokes about it, but where they've used what were potentially reasonable things, which have been suggested by accountants, which are then looked at in some great in-depth later on, and then the Inland Revenue say they can't be used. Everything that we do is the due diligence is very, very tough in order for us to be able to invest or to advise on those things. And St James's Place to make sure that the due diligence only companies are done. So it's always a matter of being careful, because often a client will say, oh, I've heard of this, I've heard of that, can we do that? What about if I just put my house into trust, and for various things? And we always have to remember that some of these things, it's not a simple solution. We need to be careful. So in my experience, the best approach is to understand your exposure to taxation, understand the reliefs and exemptions allowable and what you're entitled to, and use them effectively. And then look at any other strategies from a tax mitigation reduction. The important thing is to know that you have to use them or you lose them. So be aware of the reliefs and allowances and exemptions. If you haven't used them by the 5th of April, they drop off. And we'll go through what some of those are. So 4 main types. Well, ISAs. It's just popped into ISAs, basically. That was a bit of a shock. I wasn't expecting that in one go, but there you go, ISAs. We love ISAs. So when we're looking at advice guidance, we do look at pensions first, I think, as a thing, because you get tax relief on contributions into pensions. But when we're looking at clients who are coming into retirement, where we want them to pay as little tax as possible, so a client says, I need X amount when I retire, then what you want to do is to get the most tax efficient income. And that often is a combination of using the tax exemptions within pensions, because you have some tax-free cash there. But the most effective is ISAs. And there's really sort of four main types here, which you looked at: cash ISAs, stocks and shares ISAs, innovative finance ISAs, which I don't really know very much about, which is peer-to-peer lending, and then lifetime ISAs, so ISAs which we can use. Obviously, we're building up when we're buying properties. They're quite useful because you get 25% on the money saved given by the government. But I think our focus here is always on stocks and shares ISAs, and we'll just touch on in the next slide. Actually, very interesting. Richard and I are looking at this today. So would you use a cash ISA? Why would you use one as opposed to a stocks and shares ISA? Because you're only going to really get growth, beat inflation, by using stocks and shares ISA. And the benefit of it, well, they don't get the tax relief going in, is that there's no tax within the ISA. And when you take money out of it, so there's no capital gains tax within the ISA, and the taxation is very good within the ISA. Then when you take the money from it, it's tax-free. So it's superb. And of course, you can use cash ISAs as well. So this slide is quite important because we couldn't, first of all, was looking at it thinking, what does it mean? So April 8, 2016, personal savings allowance came in. So you can earn £1,000 in interest without paying tax. And what this is showing is that you'd need, as a basic rate taxpayer, you could have, based on interest rate at say 0.45. I don't think anyone's getting 0.45 in cash-based investments at the moment, but you'd have to have 222,222 in there in order to then be over that personal allowance, so tax-free allowance, or if you're high rate tax, it's half of that. And so therefore the benefits of using a cash ISA are very limited, really. Number one, you don't get much interest, and also even where you might say, well, I want to have cash and I want to benefit from, I don't want to pay tax, so I'd have a cash ISA, but you'd have to have over £222,000 an interest rate of 0.45% before you started paying tax anyway. So therefore, cash ISAs don't, they're just not going to do anything with your money. So because we've got the allowance, and also because interest rates are so low, whether they stay low, I mean, it's saying that for the foreseeable future, they're likely to be reasonably low. We're looking at some slight increases maybe this year, but nothing magnificent, nothing large. So cash is not king at the moment. So how will you use your ISA allowance? Stocks and shares ISA is a better way of using the allowance if you're investing for the longer term. So we will only invest into stocks and shares ISA for money that's not needed in the medium term. So that's usually 5 years, but say 3 to 5 years, but around about 5 years. And the stocks and shares ISA provides the opportunity to generate both income and growth. Some people are put off because cash ISA sounds safer, and it's cash, so therefore it is. But we have portfolios that can go from conservative up to adventurous. So we can sort of try and make sure that you're investing in something that suits your profile, and then can be achieving growth and also provide income as well. Also, stocks and shares ISA doesn't just always contain equities. So within our portfolios, you can have various other elements in that. So it's important that we have a blended approach to that. So the important thing is, if you don't use your ISA allowance before the 5th of April, before the 5th of April, it goes. And you've got a £20,000 allowance each year. So if you can, just put anything in. If you put in £100, or if you put in a regular amount, £100 a month, £500 a month, or the full £20,000. So important, just get something into an equity ISA. Junior ISAs, JISAs. So for anyone under 18 years old, the maximum that can go in is 9,000. Again, normal things, gains free of income, capital gains, and they have no control till they're 18. So a parent and grandparents. So really useful for grandparents to get involved in paying into their grandchildren's JICEs, and as part of inheritance tax planning. So I have clients where we're using their money to invest in for the grandchildren, into the others. And so the child trust funds have sort of disappeared now, really. So I think JICE is the way to go. And I just think it's great. And this is an amount of, if you put it in from when they're 0 up until 18, then they do take control. Sometimes maybe 18 is a bit young for them. So do you tell them they've got one? But basically, what a great way to save towards university fees or deposit for a house, I think. So the theme of tax efficient investing, there is still advantage of choosing investment over a cash deposit. So if you're using other things, so unit trusts, the first £2,000 of dividend income from a portfolio of shares or equity unit trusts are free of income. Using your allowances and exemptions within the unit trust, and then investment bonds are something that we use because there are benefits within there where you can defer, so that the return of the income coming in, so up to 5% per annum for 20 years is deferred. So they work quite well. And you can also use trusts around bonds, and then pensions, which I mentioned briefly. I think we'll go on to a little bit more detail on pensions as to why they're so important. So within each of our things that we would use, so basically an investment for a client into a pension, a unit trust, an ISA, or a bond, we're using different taxation exemptions within that. Yeah, and bonds are something that it's where you can put into trust. You have to look at when you do it and the effect of doing that. But that is a good way. I always think of a bond as sort of where you can bounce money down the generations and keep some control over it. Retirement planning. So saving for a pension is hard, but retiring without a pension is a lot harder. I think that's true. So state pensions, obviously, they've all moved on. They're moving 66, 67. I think, Richard, they're going to 68 soon?
Yeah, no doubt.
Yeah. So, and so roughly people are getting sort of about 10,000, I think, from their state pension, sometimes a little bit more if they've had various elements of SERPs or the one before SERPs that's gone from my head now, but so yeah, we've all got to, unless we're in final salary schemes, copper bottom schemes, then most of us will be having to pay into defined contribution pensions, and that's hard work. So story here, although I think recently it's the first time first time in many years that life expectancy has actually gone down, I think, hasn't it, Richard?
Yeah, it's slightly dropped, isn't it?
Slightly dropped. So this is looking at UK life expectancy for 65-year-olds from 2062. So we're living longer. So how long do you fund a retirement for? Longevity is often underestimated by many. The length of time the pension pot may need to provide an income in retirement. So when we're looking at how you take your pension benefits, if we're using, we use a combination potentially of annuities and drawing directly from the fund, we have to be so careful about how long you're going to live. So we're looking at most people living 84, 86 easily, and then the 1 in 4 chance of living to 102, I think, which most of our clients are, how we look. So a baby born in 2020, and this is their chance of living to age 100. So obviously females, greater chance of living to 100. So it's not getting any better because of improvements in health apart from the pandemic. Nearly a third of children born today will live to age 100. we're likely to see so basically the shifting demographics, so that an increasing number of elderly with a reduced workforce to support them. So that's always the problem really with the schemes we have with police and nurses and doctors and civil servants, because there's no fund for those pension schemes and they're paid out of tax, which is why there's been a lot of work and how they had to alter them. So pension provision is increasingly important, and broadly speaking, we should all be putting more away for our futures. And again, it's always chipping away, that compounding effect with ISAs, with pensions, with savings. Just keep on doing it, and that compounding effect always works. There's been a few changes in pensions. So basically, HMRC are looked at how they're going to. Well, there's a Gordon Brown rate on pensions to start with, and then over the time they've increased the rate. I'll call it that. That's a bit contentious. So the annual allowance is basically how much can you put into a pension. I can remember at one time it was just, it didn't matter how much you put in, and it didn't matter what the fund got to, and these things have all changed now. So depending on your earnings, you could get to a point when the maximum you could put in is 4,000 a year. Mostly for most people, it's around about 40,000 a year. So the last pot shows the position today, and for additional rate income taxpayers, the annual allowance is reduced or tapered for those individuals with threshold income of over 200,000 and adjusted income of 240. So these are sort of technical terms that we have to work with, but basically sometimes you can't put in more than 4,000, but you can use carry forward for 3 years. So sometimes we can use unused release for 3 years. But basically it's gone from 2010 to 11, where you could put in 255,000 a year, down to potentially now between 40 or 4,000, depending on your earnings. And then the lifetime allowance is something that's a little bit more significant as well, in that there's a taxation on your pot over 1.731 in 2021. So in 2010, you could have a 1.8 million in there. Before then, it didn't matter what was in the pension fund. So we have to watch that lifetime allowance charge. So that's been squeezed by consecutive governments, whilst protection for some have been available, for the majority will be capped at a limit of 1.73. And this limits the size of income that can be realistically taken. So at 4%, that would give you 42,000 a year. So in the spring budget 2021, the Chancellor announced that lifetime allowance will stay at the current level until 2026. So that's where we have to watch your pension pots. And then then look at how you take your pension so that you're taxed as little as possible at various times. We need to just work through that and manage that situation. So this was an interesting stat. So we were looking at this the other day. So if you have a pension fund of 300,000, you're 40 years old, and you want to retire at 65, you assume a growth rate of 5% per annum, it could get to 1.15. So it's really important to know that we have to be careful. And that's the compounding effect of 5% per annum growth. And then we did a little bit more work on, I'd always thought there was this thing where if you can pay 3,600 into a pension without any earnings. And we did a bit of calculation just on the back of not a fact packet because no one smokes, but on the back of a note, that if a grandparent paid 3,600 from year 0, I think by 16, the money that was in there would get to this sort of figure by 40, wasn't it? Yeah. So basically, you could, for 3,600 a year, you could fund your grandchild's all that they ever need to do, and over that 16 years, plus pay into their JISAs, and you'd be using up some of your allowances if you used your annual exemptions or goons gifts out of normal expenditure, and you could be transferring money down the generations. So that's quite an interesting scenario, that one. So why should you invest in the pension? So tax relief on contributions, on eligible contributions, tax efficient growth, 25% tax free at retirement, flexible options with the new drawdown. The funds, while they're in there, are inheritance tax exempt, so they're not added into your estate when we look at a pension fund, and the tax efficient options for beneficiaries. So depending on when you die, the rules change slightly. So it's, on our advice guidance, basically, we look at pensions first. So have you maximized pension contributions? Could you do things at work? Could you do salary sacrifice and get some more money in from the company? But also always look at pensions first, then ISAs, although pensions throws your money into the future and ISAs is more medium term. But overall, those two things working towards when you start to take benefits or retire, as we call it, is just amazing. Absolutely wonderful things to use. So the changes have not all been one way. Recent legislation means that the accumulated pension pots are an incredibly efficient way of handing assets to the next generation. So although we've had a reduction in what you can put in and the amount that you could have in there, in the old days, you would normally buy an annuity and then you'd leave, you'd usually have a spouse's pension within that. And then when you died, that would be the pension gone. Whereas now, with the flexibility of drawdown, then the pension fund can go down the generations, which is really, really beneficial. Richard, I think you're going to come on now and do the different way.
Yes. Okay, have the next slide then.
Pension death benefits.
Oh, sorry, didn't tell me about that one. Thank you.
No, I think we discussed this.
So yeah, I mean, one of the main things about death benefits is people often say, well, it's great, let's have a pension, but what happens if I die? So at the moment, if you have a pension fund, this is the current rules because rules change all the time as always. If you die before age 75, your spouse or your nominated beneficiary, whatever you decide, can take various options. One option is to take the fund as a tax-free lump sum. Another option is they can go into dependents drawdown. So effectively continue, if you're in a drawdown plan, continue to draw an income off your fund, or C, you can purchase an annuity. But the biggest issue here really is post 75. So pre 75 is tax free and free of inheritance tax as well. As a pension fund's always free of inheritance tax. So it does make it a good planning opportunity. So another option before 75 is also to pay the benefits into a trust. The idea of a trust is to allow the spouse still to access the money, but because they're borrowing the money from the trust, they have to pay it back. So therefore, it doesn't form part of their estate for inheritance tax planning. So using a trust is another option before 75. After age 75, if the money's taken as a lump sum, it is taxed if it's taken as a lump sum at 55%. So again, if you're in drawdown, it's really important we stop, look at the options and don't necessarily go down one route or the other, because again, a dependent can go into drawdown and continue to take an income from them. It's also an asset that can pass on to other generations. So even after the death of the spouse, it can go to other nominees, which can be children. So the idea of pension, this rule, people used to always say, oh, my pension, what happens if I die? It dies with me. Effectively, it doesn't. It can actually be an asset outside your estate for inheritance tax purposes and can be passed down by generations.
Cool. I think this one, children's pension, we sort of touched on already, which shows 3,600 per annum. So anyone can pay a pension without any earnings up to 3,600, which is 2,880 net, because you get the 20% tax relief on top. Parent guardian must apply, but other adults can contribute once set up. And they can't get that till they're 55. But yeah, just a brilliant way of being able to pass money down the generations, and basically, sort out their pensions, sort out their deposit for houses or the uni fees, if you can. So, which is good. So 4 pillars of tax efficient investing.
So that's me.
Richard, I think this is you.
Thank you. Good evening, everyone. So I've been quiet up to now. This is my bit. Effectively, when we're looking at financial planning, the idea really is, where are you? Where do you want to go? And what we want to try to do is fill in the gaps in between. So it's about having this vision of if it's retirement or slowing down work or changing your career, where do you want to be? What income do you need? And then working out how do we then produce that as tax efficiently as possible, but also have the flexibility to adapt to so many different what if scenarios in that journey. You know, what if suddenly a child gets married, which they generally do? How do I fund that? So it's just about whatever we do, it's about keeping it under review and looking at where you are, where you're going, and constantly testing different ideas. So we got these 4 pillars of tax efficient investing. So we talked about ISA, great vehicle, tax efficient income retirement, totally max them out as much as you can, because you can still access the capital, but whilst you're not using the capital, it's giving you a nice tax-free income. So taking the growth out means that hopefully we get a nice level of income, tax-free income, and keeping the asset there to be used for later generations. Problem is, it's still part of your estate for inheritance tax purposes. Next one, another staple, as Robert's already covered, pensions. It's a tax reducer. We don't get many tax reducers in this world. In fact, we get very, very few. It is a staple point. We always go for pensions first, because as Robert said, you get 20% tax relief immediately. And currently, through your tax return, you can get relief up to your marginal rate, which if you're lucky enough to be a 45% taxpayer, you can claim you have a 25% back for your return. Every single budget, there's always noises, it's going to go, it's going to go, it's going to go. I've been hearing it for years. It's not gone yet, but obviously at the moment, the risk of a pension is you can do it hoping for the additional tax relief, but we can't guarantee that it is. But at the moment, 20% tax relief, definitely even for the basic rate taxpayer. The biggest problem already is, as Robert alluded to, one, we can pay less and less than each year. And if we, again, are lucky enough to be earning over 200, the amount we can put it in starts to be tapered down, all the way down to 4,000. So if you're earning near on 300,000, the amount you can put in goes down to about 4,000. So it becomes, as much as a tax efficient vehicle it is, the fact is the more you earn, the less advantageous it becomes, because we just can't do much with it. So what that introduces, are there any other tax reducers out there? And there are, but it's quite a different type of way of investing. Whilst the pensions and ISAs, these nice diverse portfolios, what we're looking at is the enterprise investment schemes and venture capital trusts. Basically, these were introduced in 1994 with the aim to really try to get people to invest in small, emerging startup companies. So by the very nature of that, small, emerging startup companies, as you can imagine, much, much more risk, much, much more illiquid. It's not one of these sort of things whereby you can put your money in and necessarily get it back in 3 years, 5 years, or even 10 years. These things take a long time to actually develop and come to fruition. Very, very exciting if you know you're happy with the level of risk. And these are deemed to be upper medium, if not higher risk investments. So it's not something we look at casually. We have to be looking at, are we maximizing your ISAs? Are we maximizing your pensions? Do you have any appetite for this sort of thing? Because effectively, to encourage us, as I said, from 1994 to invest in these schemes, they will give you 30% tax relief. It's a tax reducer, so it's not. So you've got to earn the tax to actually get the tax relief. But so it's quite advantageous, obviously, to have that sort of level. There's also something called the seed EIS, which is real startup companies where you get actually 50% tax relief. But there are a number of caveats. For example, on an enterprise investment scheme, you've got to hold it for 3 years. Venture capital trust, you've got to hold it for 5 years. So during that time, if you want to access your money, they'll reclaim the tax relief. So you've got to be very, very careful. Maximum income, maximum investment between 1 million to 2 million for enterprise investment schemes, 200K on venture capital trust. So why would you choose an EIS over VCT? A couple of things about enterprise investment schemes. One is you can actually defer any capital gains. So for example, let's say you sold a property and you made a £200,000 gain. You can actually invest that gain, or a proportion of it, in an enterprise investment scheme. And effect, even if it's after the event, after 3 years after the event, you can claim back the capital gains tax, CGT I call it, paid. So, and it shelters in there, and it will not come out until you actually come out of the EIS. So some people, maybe in later life, will actually decide they're going to defer that gain indefinitely. by rolling over one EIS after another, and you can keep deferring that capital gains tax. So it's one thing why somebody might use it. Also, with an enterprise investment scheme, once you've held the shares, once they've been issued and allocated, it's free of inheritance tax. So after 2 years, once that scheme is held, you're free of inheritance tax. So again, some people may be concerned later in life with longevity and want to get a chunk of capital outside their estate. It may be something that they've sold an asset, they've got this property and they've sold it on. So can I just go back to venture capital trust? Sorry, very quickly, so I'm banging on a bit. Venture capital trusts, you don't get capital gains tax with deferral, but you get tax-free dividends. So again, that might be a reason you might go into venture capital trust. So these really are complex investments, very, very speculative, and therefore it's understanding that level of risk. So we have panels of EIS and VCTs. They're vetted, but it's a very, very in-depth conversation before we start looking at any of these sort of vehicles.
So a client might use this if we can't use pension for them anymore, if they need to defer their CGT, and or we need to sort out an IHT problem with a shorter time period, like the 2-year time period. Something like
absolutely, but again, it's still not a given that you just do this sort of thing. It's got to be, you've got to have a risk appetite. Even with loss relief, which basically means any losses you can claim against tax paid. So there's ways you can even claim anything you lose on these against future tax bills. So it's potentially very, very tax efficient, but we've also got to realize you could sort of go for full loss. Every company investing could fail. So although you may still get back equivalent about 50-60% because of all the reliefs, it's the sort of thing that the nature of these sort of companies is highly speculative. Next slide, please. Business relief. We run business relief schemes. The idea what business relief is again a way of investing to try to reduce inheritance tax. So it's not really deemed to be saying we're investing for growth, although growth obviously is a good objective. The idea is if we invest in a business relief scheme, once those shares are owned for 2 years, it's free of inheritance tax. So again, it's one way some people might look to try to reduce an estate. And interestingly, powers of attorney can actually invest in these, because if anyone's been a power of attorney, they realize that the ability to gift and do other exciting things with investment are very, very limited. But business relief is a legitimate type of investment that a power of attorney could get involved with, which after 2 years of holding these shares, usually AIM shares on the alternative investment market, it's free of inheritance tax. So again, business relief is a useful exemption to try to use where it's appropriate. Next slide, please. Inheritance tax. Okay. So inheritance tax, estate planning. Okay, people have been on these seminars before. We've covered the IHT, this £1 million magical band, which is great. We all have £325,000 of the personal exemption, and then on top of that, we pay tax of 40%. But additional, from April 2017, we also the government introduced the primary residence allowance, which gave you another 175,000 each. So if we think about it, 325 times 2, 175 times 2, that makes $1 million. Because on death, if we are looking to pass the whole estate to the spouse, there's no inheritance tax. But the problem then is all the money is in the spouse's estate, and then the inheritance tax is payable, but you get the £1 million exemption. So it's good part of inheritance tax planning. We look at how you've written your will, whether you put in nil rate band planning in the will. Have we looked at trusts? Have we looked at gifting? Have we looked at nominating charities to reduce inheritance tax? So there's various ways when we're looking at inheritance tax to actually reduce that. So there are various gifts with reservation, different ideas, but ultimately if you give money, which is great because people say I reduce my estate by giving away £100,000, fantastic, because after 7 years it's outside your estate, but you can't touch it. The idea is gifting means gifting, so the difficulty sometimes is I would like to give money away, but what happens if I need it? What happens if I need an income from it? And that's one of the ways often that a lot of inheritance tax planning is ideal in concept, but it's really sometimes quite difficult to execute, because this whole point of, if you give money, you lose control of it and you lose access to it. The next slide, please. You have various little exemptions you can do. And again, when we're talking to people about inheritance tax planning, you can give £250 on an unlimited number of people each year. You can give £3,000 to a single person each year. And obviously, if you haven't done it the year before, you can give up £6,000. Obviously, wedding gifts up to £5,000. And this thing that Robert mentioned, a goon, which we call it a goon, it's regular gifts out of income, gifts out of normal expenditure. So effectively, if you earn more than you need, as long as you can demonstrate it and document it, there's no reason you cannot gift any excess income away. Really, as long as, again, it's all about making sure you document this sort of thing, so it's always visible that you've been given, and that will fall outside your estate straight away.
That's an interesting one because it's unlimited. A lot of people don't realise it, but it can't be from capital. It's got to be surplus income, and it has to be sort of regular. So it works really well for school fees planning, that sort of thing, or for a regular payment. But it's unlimited. I mean, there's quite a lot of scope there, as long as you keep the details.
Yeah.
And that 3,000 is the donor. So that's me as a person. So I can give 3,000 a year away, and Richard can give 3,000. We could give it all to Alison, but that's our own 3,000. The 250s, you can go up and down Berkhamsted High Street and give out 250 to every single person you meet. There's one way of dealing with it. But it's important to remember that the 3,000 is on the individual, not on the person receiving.
Okay, and next slide, please. Okay, using trusts.
Yeah.
So effectively, as I mentioned earlier, using trusts to gift, or as we say, conditionally gift. So it's a case of, how can we give money away? How can we use trusts? But how can we have some sort of control, some access to capital perhaps, or an income? So effectively, we look, when we're looking at estate planning, we say, how can we use trusts, making sure we're using up all your gift and exemptions. But we have different types of plan. We've got so-called a gift plan, enhanced gift plan, a loan plan, a discounted gift plan, and business relief solutions, which were mentioned earlier, give you the shares after 2 years. So I'm not going to go through all of these, but we've got an example coming up, which is the discounted gift plan. Now, this is an interesting thing because, again, giving money away, lovely, but what happens if you still need an income? So the idea about a discounted gift plan is you make a contribution, and it's usually into a bond, and you also, retain a right to income, and the right to income is based on whatever percentage you take. So if you take 5%, you have that income for 20 years, 4%, 25 years, 3% and onwards. So effectively what you're doing is you're gifting the lump sum. It goes into a trust, but you're retaining the right to an income. So it allows you to, gift but retain the income. After 7 years, the gift's outside the estate. So it's just that combination of, yes, I like to give money, but I don't want to lose that ability to receive income. So basically, this is what it is. A discounted gift trust is set up. That is invested. The gift is put into that, which is invested into a bond, and then keep pressing the button. Thank you.
I'm doing that.
On death, the residual passes to the beneficiaries, and you receive an income for life, which should come up any second. Yes, thank you.
There you go. And I think the important thing is obviously we're talking about crunch time. So is remembering that those allowances disappear each year. So your gifting allowances disappear each year. And then when we're looking at gifts, well, potentially exempt transfers, they're called, well, we're giving money away. Your clock starts ticking over 7 years. So the earlier you do it, the better. Trusted a little bit more complicated because it's not, there is a different, it's called a different thing actually. So it's a CLT, chargeable lifetime transfer, as opposed to potentially. So it's just a matter of knowing that if you're going to do anything, it's a very delicate balance of when you do it, but often get on with it because of that clock ticking thing. But so many times people say, oh, I want to I want to deal with this and I want to put my residential property and give it away. And you can't, because Richard mentioned already gifts with reservation of benefit. You can't give it away unless you pay market rent. So we have to really be careful about all these things and understand, but it's often about timing. Sorry, anyway.
Next slide, that's fine. Go on to the next one, please, Alison. Okay, so just to summarize, if I may, ISAs, yes, make use of them. Great source of tax-free income in retirement and tax-free growth. And of course, if you can fund grandparents funded junior ISAs, use up your personal savings allowances, pensions, always a staple of all our financial planning, the tax reliefs, the fact that the fund is free of inheritance tax. Use up your capital gains tax exemptions. If you're disposing of shares, you could try to arrange it that you have one disposal before the end of the tax year to use up your exemption and one afterwards. Also, you can transfer shares to your spouse. So again, to make use of their exemption. So again, it's worth thinking, if you're making a disposal, try to time it, talk to us. You say, look, it's what I'm looking to do. Before you do it, let's have a conversation. And then we can bring in things like, are things like enterprise adjustment schemes, are they appropriate to defer that CGT liability? Have you got the appetite? Dividends, within an ISA, tax-free. So again, that's another way we get, obviously, part of the tax-free income in retirement. And effectively, it's like venture capital trust, tax-free dividends. Because for me, it's all about however we design your income in retirement, being as tax efficient as possible, using up as many allowances as we can, but most importantly, reviewing it every year. Where are you? What do you want this year? How do we extract it from your various investments? We need to get these investments up and running and working for you to be able to say, right, your retirement, how much do you want? Where are we going to get it from? And of course, inheritance tax, as we move on through life, what do we want to leave to our families? What do we want to leave to the taxman? Which is obviously the other thing we've got to consider. So,
is it voluntary? Is it a voluntary tax? There was a saying, isn't there, about, I can't remember who it was. I'm sure
it's inheritance tax is a tax for somebody who mistrusts their beneficiaries more than the Inland Revenue or something like that.
That's it.
So that's my bit over, isn't it?
So there you go. The purpose of the webinar has been to give you a good overview of the tax considerations for 21-22 tax year. We all have unique circumstances, therefore it's always best to have a review to understand your own situation. One of the tools that we use is tax health check. And there's a set of questions we can run through you to determine your current tax health and to identify if there's any areas where you potentially make improvements. So if you'd be interested in doing this, then please contact us. And then we'll go through the call with you. So we're sort of coming towards the end now. And if you have any questions, please do put them into the chat there and then we can answer them. And we just thought we'd do a little bit of an informal update on the market and what's going on. Obviously, we've had COVID. We're all aware of inflation. I was talking to a client of mine earlier this afternoon, really just talking about the basket of goods in the shops. And then yesterday we hear on the news about petrol prices, and then we've got the Russian thing going on. So it's there's a lot of noise, we call it, out there, and so it's important to remember our fundamentals. So Richard, I know we did some webinars recently and and you had to chat with some of our investment consultants.
Yeah, I think the most important thing is, with investing, is taking this long view, and it's really, really easy to say when it's going up, but when it's going down, it's the different emotions that take over. All we can do is learn from history, and history says we always come out of it. Every single time the markets dip, it's what happens in markets. It's normal behavior, and if you look over your investments, anyone who's held investments with us for a number of years, you look at your wealth account and you see the spikes up and down. It's quite incredible how much it goes up and down. But the key is it's always an upward trajectory. So at times when it goes down, especially if you're a recent investor, it can be quite disconcerting. Say, well, I've just invested my money and it's gone down. Totally understand that. Pick up the phone, talk. And hopefully we can reassure you, it's what markets do. It always has done. At the moment, January 2021 was a really good year in the end. Most portfolios were up 10 to 14%, which is lovely. Wasn't quite the same in 2020, because in 2020, if I look at, sorry, I can't show any slides. I have to get these. It's sort of a bit last minute, and I have to get these things signed off. So I haven't been able to do it. So you just have to trust me a bit on this. In 2020, between February and March, we know why, but the FTSE was down 33%, which is quite scary. That's if you were in a FTSE tracker fund, which people do, you were lost a third of the value of your investment. If you'd just gone in, that would be even more scary. Rather than losing a third of your growth, it'd be losing a third of what you put in. The MCR World Index, I mean, the FTSE did really, really suffer. The global indexes were down 25%. And the importance of diversity here, and this is where active fund management, when the market's going up, it's very, very difficult to demonstrate where value is in active fund management, in diversity. Where it does matter is when the market is starting to go down. So in 2020, FTSE is down 33%. Our investment portfolios they're all down, so we're not going to go, isn't it fantastic? They're down minus 10%, minus 14%, minus 16%. So what you've got is effective management, whereby the spread of assets, diversity of asset class, basically holds up against these severe fluctuations. Now, by the end of 2020, most portfolios are up. If we'd said on the 20th of March, don't worry, everything will be up, you'd go, no way, can't believe you, it's down 20%. But that is the nature of markets. We can't predict it, but invariably, whenever we have a big drop like that, it always comes back. So that leaves us obviously to this January, which has been a pretty rocky start, as probably you all know. In the S&P 500, the American index, interestingly, that 5 companies make up 25% of the value of the S&P 500. Yeah. 5 companies. It's incredible how much. We know what they are. Your Facebook, Alphabet, Google, Netflix, Apple. Sorry, Mr. Apple there. And actually, January, the S&P was down 11% in the first 16 days of January, which is the worst ever start to a calendar year on the American markets. And what's driven that? Basically, inflation fears. We know the cost of living is rising, petrol prices, etc., and that puts a pressure on companies, their manufacturing, the cost of their goods, etc., which a lot of them can pass on to their customers, but not all. So inflation has an impact on global markets. We've also got issues, as we know, Ukraine, Russia. Markets were down about 140 points yesterday, back up 50 points today. So what's causing that? And it is that ongoing volatility, but it's understanding that is the nature of markets, but always looking through this, looking through the long term, having some good asset allocation means that, as I said, even if we look at the last 2 years, most portfolios, including COVID, have still produced 14, 15, 16%. So again, that's just historic. And obviously we can't show you this, but really the key is inflation is having an impact. Ukraine, Russia's having an impact. These things do upset markets. It does create volatility. Long-term holding assets will outperform any other asset class. So we just have to sometimes just think, okay, it's down. I haven't lost anything because I'm not cashing it in, but it's gone down in value. And we just have to hold the course. Why are we investing? Is the reason we invested today the same as it was yesterday when the markets went lower? Yes, it was. Then just keep an eye on where you're going with your investments. It is, January has been a volatile month, but obviously compared to 2020, nothing like that. So I think we'll see some more volatility, but the main thing is just holding the course, making sure you've got lots of liquidity as well, cash reserves, and it does work out in the end. Yeah. So that's my very quick update, which I hope is some use. Again, please, talk to me, talk to Robert, any concerns you have. We can analyze your portfolios. If you feel you're overweight in any particular area, US, Japan, or whatever, we can talk that through with you. So it's a case of just, please don't worry, have a discussion with us. Always happy to talk.
Yeah, and I think, I mean, with the proposition that we have with St James's Place is with the investment committee and the outside analysts is that their job is to look at the portfolios to make the changes that they need to. Sometimes we need to come back and say this is the reason why something is doing something, because we could be overweight in the US at the moment when the US as S&P is down, and we could be less weighty in the UK, whereas actually in January the UK FTSE looked a little bit better than everything else, and yet our portfolios are where we've got a broad spread of investments are actually not following that suit. So sometimes it's good for you to know that our investment committee and our analysts and our managers know that, and they will be looking at what they need to do if they need to make any changes. But the main thing is always a broad spread of assets, of different asset classes spread geographically around the world, and that this sort of stuff, including the various things we've had, 1987 crash, the ERM, the 2018, 2019 wasn't too good a year. In the end, they become blips on the graph, and it's always, as Richard says, always a matter of, if you don't need, we invest for the medium to long term. We like you to keep the money you need in the short term in cash, and therefore we're not often looking at actually taking large chunks of money out at the moment. Therefore, staying in is good, and that's so for pensions that works because you're drawing continually from the investment rather than just in cashing. So that's why don't worry so much about the noise that's out there, because it will be a blip on the chart long term. But our job is to then help you go through that. And certainly through 2020, through March, if everyone had gone to cash, that would have been the wrong decision, because when the bounce comes, it comes quickly and you miss it. And so it's always a matter of saying, okay, if you need the money out for a reason, that's different. But otherwise, stay calm, and over a period of time, we will get there. And so, yeah, stay calm, carry on. Cool. Alison, is there anything that we need to talk about or anything?
No, I think we're absolutely fine. Thank you.
Okay, we're good on timing?
Yep, we're good on timing.
Good. So hopefully we've covered off some things here. So the important thing is if you don't use it, you lose it. And I think that happens in many things in life. And I think we should remember that. And it's a bit like everything we do, eat a balanced diet, good spread of investments, good spread of risk, and just keep on keeping on and keeping at it. So hopefully we've covered on some areas here on why tax planning is important, why this time of year is important, why we'll be writing to you about ISA top-ups, etc. And please do come back to us at any time. Please do some feedback with us so we know what topics you'd like to hear about going forward. We hope you've enjoyed this. We've really enjoyed being here with you and putting this together, and we look forward to doing it again with you very soon. Thank you very much.
Thank you, everyone. Was there any questions at all, Alison?
No questions. If you could just stop the recording, please, Robert.